Hey everyone, welcome back to the channel. And today we're doing something that you've been asking for. A lot of comments about this one. A lot of people on our Patreon have talked to us about this, and that is the income bucket of our three bucket system for the for retirement portfolio. We're going to explain it all. The income bucket's that one bucket that everyone always talks about. It's the most exciting bucket. It's the interesting bucket. It's the bucket everyone wants to start with. And today we're going to explain all the details of how to build the proper income bucket, how to make it work, where your dividends are flowing in from, and the cash flow coming out that you're going to be able to live on. You're going to have your retirement income to live on, the cash flow you're going to need, and to enjoy life in the retirement years. So before I do, I got to do a shout out to all of our Patreon supporters. Thank you so much. So many of you have joined, and we're trying to give you as much information as we possibly can as time will allow us. So if you want more information, go down below. You'll see a Patreon link. Click on that. And if you want, you can support the channel that way. The first version is free to get you some information. If you want to support the channel, there's so much more you can get out of the channel and out of myself. And then also, I got to thank all of you new YouTube subscribers. Thank you so much for joining us and enjoying the videos. Let's get into today's video, the income bucket totally explained. Quick important disclaimer, this content is for educational and informational purposes only. This is not financial advice. If you need financial advice, talk to a financial advisor, and past performances do not guarantee future. Hey, before we do, we got to do a quick commercial break. And that is for our Retirement Made Easy coffee mugs and now our license plates, which are awesome for golf carts or some vehicles. It's just something new that we've added. So many people have asked for different things. We're trying to add what we can. The reason why we do this supports the channel. Yes, those little $8.99 coffee mugs and the $6.99 license plates all help support the channel. Use the QR code on the screen or go down in the description. You'll see the links down below to get into it. You can order your coffee mug license plate for a loved one or for yourself. These things make great gifts. The reason we do this is it all because it helps support the channel, so we don't need advertisers. We don't need to find anyone who's going to tell us differently, give us a biased opinion that you see so many YouTubers do. We sit here, we're going to just do something with a little logo, and you guys are loving it. Thank you so much who has bought it, and if you haven't, don't be afraid to click that link. So just give you a quick refresher of what we have. The three bucket retirement portfolio system. Bucket one is the foundation bucket. That's kind of what you build off of. This is going to be your cash and your short-term investments. It's something that's going to be safe, stable. It's the essentials that you need to have. Now that bucket, basically, as it grows and as it develops, those funds will roll into the growth bucket. And that's the second bucket of the platform. The growth compounds, builds, develops, helps grow the future of this portfolio. You're going to have it in stocks, growth investments, growth ETFs, and then the growth of that as you rebalance will end up going into your income bucket, which is the one we're going to talk to today, which is the income, the cash flow, and that bucket that gives you the freedom to live. It's going to be your dividends, your income generating assets. It's a simple and balanced, built for life plan. I've been living on it now for well over 10 plus years. So this is the system, and we're going to talk today about that income bucket. Now, the number one rule here, income is not yield only. So many people I talk to, they always want to talk to me. Oh my God, I want this fund. It's got a 30% yield. I got this fund. It's got a 20% yield. Yield is a mathematical number, okay? So a yield tells you what the distribution, the amount that the distribution is coming in from, and the price of the share. Okay, that's it. Okay, so what we're saying here is the price goes up, your yield will go down. The price of the stock goes down, the yield will go up. It's that simple. That number told you absolutely really nothing. Okay, and this is why we don't chase yield on this channel. We don't chase it. High yield returns don't mean anything. Don't chase those numbers. What you want is the goal is a long-term paycheck, not a quick flash big yield that ends up giving your money back to you. So the purpose of the income bucket is to really do one thing, is to create dependable monthly cash flow generated by high yield assets. Now I'm going to stop right there because you're going to say, well, you just told us not to go after high yield. High yield assets is where we start at. Everyone can go find a 10, 20, 30% yield. But what we have to do is focus on the checkpoints that we need to come up with to show you that these high yields qualify or don't qualify into our income buckets. It means one of these things that we got to make sure that we're doing the proper thing. So what we have, meaningful monthly income. There are weeklies out there. I'm not saying they're bad. I'm saying that there's weeklies, but we want to make sure we have monthly income, and that a weekly tallies up to your check at the end of the month. What we're trying to look at is how do we balance ourselves out with a total monthly income. We want to, too, be strategically diversified. We don't want to be all in the S&P 500. We don't want to be all in tech. We don't want to be in just one company. And you see that from so many people on YouTube. Oh, can I retire on this fund? Can I retire on this fund? You don't want to retire on one fund. You want to be diversified. You want your asset value to maintain. Okay, this is that NAV, the one thing that everyone talks about, NAV erosion. Asset value maintenance needs to maintain your net asset value to avoid long-term structural erosion. Okay, you want to reduce your share liquidation. It means you don't want to sell shares during market downturns to pay for normal retirement expenses. You want to preserve your nest egg. So the goal of this fund is income, diversification, maintain the value, and make sure you continuously grow your funds. So selecting the income fund, I really believe there are 6 total steps in when you want to select a fund. Step number 1, what does the fund actually own? I didn't start with yield. I said, what does the fund actually own? You got to identify the assets, the S&P 500, tech, bonds, gold. You got to see if the majority of this is long-term, or is it long-term risk, or is it long-term return? We always call it long-term risk and return. We want to figure out which one's this one's going after. And then the option strategies can change the delivery, but not the underlying asset. You see so many funds say, oh, we made these minor changes. Oh, we changed this in the fund. This change got funded 3 months ago. Why did it change? Why did it do it? So the first question is not how big the yield is, but what engine drives it. The second one, how does it generate its income? Is the income sustainable or destructive? And yes, income can be destructive. What's the source? Is it dividends, interest, premiums, or is it just point blank capital gains? 2 funds with 12% yield can have a vastly different quality. And I'm going to show you that a little bit later. And diversification between NAV maintenance and eroding distributions. Okay? So you need to know how does it generate and what's it generating. Distribution rate alone doesn't tell you if a fund is economically earning its payout. That's where that NAV erosion starts kicking in. Examine the distribution rate. How does this fit my cash flow needs? Okay, estimate your annual income based on recent monthly payouts. Useful for budgeting, but not guaranteed yield. Watch for yield traps. High payouts while price crashing is a point blank a whole yield trap across the board. Never select a fund based on a headline yield. It's only one piece of the puzzle. Now, step number 4, NAV stability. You want structural erosion. Avoid funds that distribute more than it earns, leading to a permanent decline in value. Market participation. Seek investors that can still participate in rising markets while the yields income. Okay, maintain or grow principal over a full time of the market cycle. That's the number, that's a big goal. That's what NAV's about, that we're growing or at least maintaining our value. The total return, the scoreboard. This is the number one piece, I think, across the board. Now, I put this at number 5 for a reason. If you've done the check work off of 1, 2, 3, and 4, total return is going to answer the rest of your questions. It's going to give you all the information that you need to know and make sure it's almost like a check mark of the final check. Did I do all my homework? The scoreboard, the ultimate measure of whether your financial position is actually improving. The yield comparison, a 10% yield with an 8% growth beats a 15% yield with a 12% price decline. You know, if I'm getting a 10% yield and someone else is saying, I'm getting 15, and I've seen this, I've talked to people about this all the time. I got 10% yield, you're advertising 10% yield, I'm getting 15, I'm beating you. And when I lay down the total returns of these guys and I come back with, I said, my fund also grew at 8% and yours has dropped 12. You're really only getting a 3% yield. They don't know what to say. You need to focus on your net results, not just the headline distribution rate. And then number 6, this really gets into is where you're going to put your funds into, but it's the tax efficiency. Okay, are you going to have tax efficiency of the 1256 contracts, or are we going to use return of capital? And I've done videos on both of these. The ROC is definitely one we've talked heavily about. Neither one of them I'm going to say is really so going to say better or worse between them, but they do operate differently. So your tax, if you're putting this in a brokerage firm, tax becomes very critical. If you're in an IRA or Roth, not as critical. But this is something you need to understand and know about a particular fund. That's why every time I do a comparison, you almost literally see I do 1 through 6 on everything to give you an idea what's going on in the funds. Let me do that comparison I promised you about. 2 funds right here, SPYI versus ISPY. Now, SPYI is from NEOS, and ISPY is from ProShares. They are both invested in the S&P 500. They both do covered calls. Now, here's what starts it off with, a yield rate. An 11.71% yield on NEOS SPYI, but a 4.61% off of ProShares ISPY. Now, you'd wonder, why would I compare these two? Well, look at the next step, growth and NAV stability. The growth on the NEOS is at 5.79. Now ISPY, the ProShares, is at 13.49. Total returns are 19.35 to 19.21. So when I sit down and tell you immediately, I give you my 6 different comparisons. Which fund would you rather have in your income bucket? Well, they're both based off the same S&P 500. They're both doing cover calls, but you're generating more yield with the SPYI and NEOS. Now, you're getting a 5.79% growth on top of that. So that's above inflation. So that's a real 11% in your pocket to go spend, 5% to help grow your portfolio above inflation, and giving you that total 19.35%. So it tells me right there that the total return answered my questions. It did my final check. It said, yes, you are right. I'm actually probably under a little bit with using my long-term numbers of 5.79 and 11.71, because add those together, we're really about 1750. So we're about 2 percentage points off, which is I'm happy with, because it tells me we're doing right. Now, I spy ProShares. I'm not saying it's a bad fund. 4.61% yield. If you own this one, 4.61% yield, which means you're getting at your 19.12% total return, means you're getting big growth. And that's what SPYI is for, is that it's built around a growth platform. Okay, so picking the right ones, income versus growth trade-offs. You want more growth? SPYI is right here. You want more income? NEOS is right here. And this is how you break it down. Here's two identical S&P 500 funds. Who would you choose? And the question is, what do you want, income or growth? So building the core, major U.S. equity segments, three essential building blocks in the income bucket will give you one strong portfolio. Here's how I do this. I really break this thing down into these three categories inside my bucket. The S&P 500, the NASDAQ 100, and the Russell 2000. So I have large cap leaders, I have innovation and heavy tech in NASDAQ 100, and I have the small cap potential in the Russell 2000. So any one particular one could go strong. Right now, small caps have been going crazy. Okay, the NASDAQ's pulling back. The AI is being pulled back. But I have a diversified, balanced, built for growth, built for income between all three of these simple categories. Now, building the core, I'm going to say right up front, I am just showing you funds that I personally own. I am not sitting here saying that these are the only funds available, because I'll tell you up front, right off the bat, I know I'll get this. Well, the Goldman Sachs wasn't in there. Doug, you forgot this one. Doug, you forgot that one. I wanted to make this a simplified pick for you. I showed you how to pick funds. Now I'm going to show you what I picked and why I picked what I have. Now, these are not the only ones in my portfolios, because I do have the Goldman Sachs. But let me show you what I've done here. So we got the SPYI from NEOS, and we have the QQQI from NEOS, and the IWMI, again from NEOS, all three NEOS packages, but I got my S&P 500, my NASDAQ, and my Russell. Look at down below. 1 year return, 18.97%. That's the total return. Distribution, 11.99%. Okay, QQQI, 25% total return, 14% distribution. And my Russell 2000, 35.91% total return with a 14%. If you've been following along, you will now can answer these simple questions. What is the growth of each one of the funds? And you're basically going to come down. I'm going to round up a little bit to make it simple. And that is, you've got about a 6% in the S&P 500 growth. You have about 11% growth in the NASDAQ 100. And you have a 21% growth in the Russell 2000. So what's happening here is, not only am I generating my income in the blue, I'm actually generating growth, all of them above the inflation rate. So my income portfolio is getting bigger and bigger and bigger, while paying me off what I need to do. And it's well balanced, because everyone's up, but what happens when one's down? The other thing I do is my allocation. Remember, I do about 65% allocation into my income bucket of my total portfolio. Now, inside of this, in the core, I put 70% of my allowable amount into the core products. Now, what is a core? Core is the pieces that I'm relying on day in, day out for my income. I'm working hard to get these three funds, just three funds, to do the job I want them to do. Okay? These are the funds I'm going to put money into. I'm going to maximize the amount of money I put into it, and I'm going to let it sit and run. Don't plan on selling these. Don't plan on moving these. Let it sit and let it run. Now, adding in satellite funds for diversification. Looking at gold, international funds, possibly some bonds. Again, what I'm trying to do is fill the gaps that those big companies that may have a leak in, or also diversifying it even deeper than what I want. Now, adding satellite funds is for diversification. Now, satellite funds can also be to help boost your income. If you need that extra little jolt, then we can go ahead and pick select funds. But what we're looking for is low volatility, inflation protection, and I really believe alternative income. Because I'll stop right here and say there's plenty of people will tell me QVO should be in there, or any other fund that's generating large double-digit income and not a lot of growth could be easily into a satellite to help promote this to a higher income package. And it can be done. Again, I'm just showing you how I've built a more secure type basis. Now, this is going to show you a lot of things why I told you got to do those first 6 steps. The first fund I'm going to talk about is BNDI. Okay, this is an enhanced income aggregate bond fund. Now it uses the S&P 500 as a put index, as a put options to enhance monthly income and giving me that bond exposure. So as you see, the 3 main assets class is stocks, bonds, and some cash. Distribution rate 5.73. The total return over the past 12 months is 5.43. This is the first one I'm going to tell everybody, catch with. Take those 2 numbers. What's telling you? BNDY is actually lost 0.2%. Okay, so there's some leakage out of this fund. So my whole distribution of 5.73 is not 100%. I'm getting 0.2, basically 0.3% of my own money basically back because of the total returns, because I'm losing some value into it. That's why 12% allocation max. INHI, okay, this is my international market. And international, I'm waiting for longer term. If everything would have been great prior to the Iranian war, okay, if things were going very strong, I'm hoping that will end soon and we'll be back to normal and things will take off again. But we look at an 8.56% distribution rate, a total return of 7.62. So you can see how my satellites are not as strong as my core. That's why I don't have a lot of money put into these. I went for more diversification. And then our final one is the NEOS Gold, the high income ETF. Now I wanted income from it, so I'm getting 13.77% yield and a total return of 13.85. So that means I'm getting a true yield here. This is where the rebalancing comes into, is I may have to look at my international. I may have to look at my bond side of it that's in my income package. These 2 may need to be replaced out because my total return is saying I'm actually losing some money. I'm not getting that full 8%. So it just shows you how even someone who teaches this, there's certain things in market timing, does everything, that you always are paying attention to. But in the satellite side of it, you can always use it for a purpose. I use my purpose, diversification. You may use your purpose to boost income or boost your growth for longer term protection. Now the complete income bucket allocation is this. You see my core makes up 70% of the bucket. 30% I allow into the satellite position. Now, again, almost well balanced, but I'm a S&P 500 guy. I love the S&P 500 side of it. So I went 30% into that fund, NASDAQ 25%, and Russell 2000 15%. Then I get into the diversification. I always said a little more safety, 12% into the bond side, international 10%, I call that the average play for most. And then the gold high income side just kept it in at 8%, another part of safety being mixed. So you see my chart on here, 30, 25, 15, 12, 10, and 8 across the board. Makes up the entire bucket income amount. Now, this bucket has about a $500,000 income portfolio into it. Okay. Doing my math, doing what I have, you can see I did not chase the highest yield, which would have been IWMI. I did not put all my money into that bucket. I mixed it accordingly and comfortably across the board. That gives me a $59,317 a year income. Okay, that's my estimated annual retirement income of $59,000 from this portfolio. Now, with that, I get about $4,943 of cash flow from my portfolio. That's about 11.86% weighted portfolio yield. Now, some people will say, why didn't you put it all in the higher yield stuff? Why didn't you switch it, make it 30% in the Russell 2000? You could. The problem is, I want to be more balanced. I like watching that, AI pulls back. Great. Russell came up. S&P 500 dropped. Okay. The NASDAQ 100 came up. I'm well balanced across the board with this type of a fund because I'm not chasing the highest possible return. I'm looking for long-term paycheck, as I talked earlier. Managing and monitoring the bucket. 10-point monitoring checklist I tell everyone to do. Current monthly distributions. It's easy to do. Take a look at what you're getting. Okay? You want to take a look at the NAV and the share price. If you find one that's dropping off, man, you want to start watching this. And you could do this very easily, watching it where it drops off at. You can go to stock analysis. Again, I'm not promoting them. I don't use them as a promotion side of things. But you go to stock analysis and virtually every day watch where the total return's at, and then see what money it lost today. And you can almost watch. You start reading charts a little bit. You can see if your NAV's off. But I don't have to do this every single day. I can do this monthly. 1 year total return score. Look at every one of your funds. I will tell you, you rebalance about every 6 months on these things. The first thing I would highly recommend that you do is you take a look at the total return score and see if are you growing or not growing. Put your yield up against your total return. Return of capital estimates. Now remember, this is always an estimate, because you don't know until you get your 1099 form at the end of the year what your actual return of capital is actually going to be. But that helps you budget for taxes. And changes in fund strategy. If you see that a fund changed, I'm only got to watch 6 funds in this bucket right now. So it's easy for me to read up on these specific funds and say, hey, this fund changed. How did it change? Is it good or the better for me? The trailing distribution rates. The total return performance, year-to-date total return performance. Again, going back to total returns. And the distribution trend changes, current fund expenses, and the allocation and targeting model. These are all the things that you want to be constantly looking at, the monitoring points. Are you doing every one of these correctly? Evaluate total return. Total return is ultimate scoreboard. The high yields cannot mask erosion or principal value. The princes and noise identify structural issues. Okay, if you're seeing a persistent NAV decline, do you really need that in your portfolio? No. If you see repeated cuts in your distributions, that's another telltale signal. Rather than normal market volatility. And regular reviews. Maintain a disciplined review schedule. Avoid knee-jerk trading based on weekly market volatilization. So what I always say, I'll run quarterly. I'll look at my reports. About 6 months, I'll rebalance my entire portfolio. And I'm finding it now, I'm almost dialed into where I'm not changing anything for almost a year. Okay? Because I've just simplified it so much. But again, yield alone never protects a fund's place. If it loses value or cuts income consistently, it's no longer doing its job. Every fund, every dollar that goes into this bucket is designed to create income for me. So the final thoughts of all this, total return is the scoreboard. Total return is the answer. Income is primary job of this bucket, but long-term success requires discipline, balance of yield, NAV stability, and the overall capital growth. Because even in retirement, you're still going to need growth. Not as much as you did when you were younger, but you're going to have to beat inflation. Okay? So let me know, guys, what you think of this. Hopefully this settled a lot of the questions that people have on the income bucket, how to build it, what to do with it, inside of it. If you want more, definitely leave comments down below. We'll do even more videos on our 3-bucket system, especially on the income side. Hey, I'm Doug, the Retirement Guy. Thanks for watching. And don't forget about those coffee cups and those license plates. They help the channel.